Okay, recording, Stephen.
Well, good morning, everyone, and thanks for tuning in again. As Gil said, this is going to be the last of our fortnightly webinars, and we're going to go to monthly after this, I believe. And yeah, as Gil touched on, it's really a case of there's just not a great deal changing anymore. You know, we initially did this because in the early stages of the COVID crisis, there was a lot going on, and people were very worried, as you would expect. But now, as things are seeming to settle down, the plan is that we'll go monthly, and if things change, obviously we can bring it back more frequently. But we think monthly for now will be enough to keep everyone in the loop and up to date with what's going on. I apologise, I've got a bit of a croaky throat, so just saying to Gil I might have to go get the test again this afternoon. So our agenda today, very similar to what we've done in the past. So give a bit of an update on markets, an idea on where we think we're going from here, and then Gil's insights, which I think is again a bit more of an idea of where we might be headed in the next 6 months or so. Then we'll open it up for questions, but obviously if you've got questions along the way, feel free to pop them in the chat box as we go. We're aiming to last about 30 to 45 minutes. Gil and I were speaking earlier. We don't think we've managed to come anywhere close to 30 minutes yet. They've more been 45 to maybe an hour. But we are hoping today is not going to be an overly long one. So, again, any questions, pop them into the chat box as we go, and we'll try and answer them either as we go or come to them at the end. If you're having difficulty with the sound, just try turning your video off. Sometimes it's a bit of a strain on our amazing NBN broadband, so if you turn off the video, you might have better luck with the sound. Going to record this and have it up on the website and our YouTube channel, and if you'd like any copies of the slides, let us know and we'll send them out to you. And of course, our usual disclaimer, which again I've forgotten to change the names on. Everything we're talking about here is all general. It's nothing based on your personal circumstances. If you want any personal advice, feel free to give us a ring and we can talk to you about that later. Okay, a bit of an update on markets. Last week, we saw the Australian market down about 2.2%. We did see a nice bounce on Monday this week, but then we were down again yesterday. So we're very much just up and down at the moment. Last week, a lot of our market was affected by the increase in cases in Victoria, and obviously the uncertainty about what that was going to mean. We've now seen Victoria go into lockdown, and there is still uncertainty about what that means for other states. New South Wales in particular, we seem to be, a few cases starting to leak up here. And the concern is obviously if New South Wales goes into lockdown as well, what that does for the economy too. So, sorry about that. What we're seeing is that real estate was the hardest hit sector. Again, with Melbourne going into lockdown means that a lot of those, your shopping centres, etc., the smaller businesses in there are more than likely going to close for that period, which means your Stocklands, your Westfields, etc., aren't going to get rent for that period. Because if the businesses aren't making money, the first thing they do is they knock on Westfield's door and say, sorry, we can't pay our rent. Can you give us a bit of a break for a little bit? Okay. The NASDAQ actually in the US, which is their technology index, actually hit record highs over the last week. What we're seeing is that, particularly the US market has recovered very strongly, and the NASDAQ in particular, which is, as I said, mainly the technology stocks, a lot of that driven by, I guess, the change in how we're doing things with this virus escalating. A lot of use of Facebook and other online tools, and so that's really driving that technology sector. What we're seeing, interestingly, is that there's a real disconnect happening in the world from, for a long time, basically what was happening in the markets was based on the amount of COVID cases around. What we're seeing in the last little while is that despite increasing the number of cases, we're still seeing markets rallying. So US and Brazil are two very good examples where they're having a fair bit of growth in cases, but their share markets are still doing quite well. So as I've done in the past, I want to look at the two cases, where we're going from here, the positive case and the negative case, because we are in a very uncertain time. All the data in my head and everything I'm reading, to me, still points more towards the positive case. But again, I think it's silly to ignore the fact that there is substantial risks going forward. And really, I think the next 6 months, we're going to be basically going sideways. We'll head up for a bit, and then there'll be some sort of bad news, and we'll see some sort of fall. Then we'll go back up again, and it's just going to be a bit up and down for a while. That's Steve's guess. When it comes to these things, we're all guessing to an extent. We look at the data and try and make our best predictions, but none of us know at the end of the day. So, as I said, the data still seems to be supporting the positive case. The amount of money that's been printed in US and China is driving a lot of asset growth, so share markets and housing. The figure I saw was that there's something like 18% more money supply out there this year than there was last year. So that's a huge amount of increased capital out there for investment, and it's incredibly cheap for people to get their hands on, and that's why we are seeing share markets recover quite well. Going forward, what we need to really have this positive case come to light is we need to see slowing COVID case growth in the US. So there's still a lot of concern about how the US is going to handle increasing cases over there. We need to see their death rates staying lower. So one of the reasons there hasn't been as much concern about what's happening in the US at the moment is that the death rate has dropped significantly. So in the initial stages, there was a death rate of, actually in New York, I think it peaked over about 25%. But now overall it's dropped to about 10%. And in New York, I think it's down to about 5% now. So what we're seeing is that they're getting better at handling this. And so death rates are getting lower. So even though we're seeing more cases, we're actually seeing a little bit less concern in markets around that. Another thing that obviously would help is vaccine progress. We also need to see some stimulus from the US. So there's the US stimulus ends at, I think, the end of this month. And the talk is, what is going to replace it, and, what that next package looks like, because there more than likely will be another package. And we need to see the US Federal Reserve resuming what they call balance sheet expansion, which basically means they're going out and buying corporate bonds and supporting US businesses to raise money, and so keeping the economy afloat, essentially. The negative case, which, as I said, I think is the more unlikely scenario, but I think it definitely bears talking about. So the negative case looks something like this. The US economy goes into a second shutdown because we see the death rate start to rise. We get to the point that there's too many cases, the hospitals can't handle it, and death rates start to go up. We see consumer confidence slumping. So much of what happens in investment markets is purely confidence driven. And sometimes it's really hard to get your mind around what drives that confidence. And it can be very intangible. It can be just a slight shift in mood, and consumers lose that confidence. At the moment, there still seems to be a lot there, and that's based essentially on government stimulus around the world and confidence that governments are going to do what they can to keep putting money in people's pockets. So even if they don't have a job right now, they still have money coming in, and therefore they're confident to go out and spend it. Australia, they're talking about extending the JobKeeper payment further. And as much as anything, I think that's about increasing people's confidence, because if they can see a date that suddenly they're going to stop getting paid, people start to keep that money and start putting it away for a rainy day, which is not what governments and businesses want right now. They want people out there and spending that money. So people need to have confidence that that money is going to keep coming in. If we see that confidence slumping, then we see the US economy start to stall, markets themselves, so share markets start to lose confidence in governments, in their ability to keep printing money, keep putting money into people's pockets. And then we start to see those growth stocks that have really been performing well, so particularly those technology stocks that I touched on earlier, we start to see the premiums that are being paid for those start to unwind, and we see a bit of a fall in share markets. So that, to me, is the negative case. The factors that we need to be looking out for that are going to drive which way this goes, whether positive or negative. In Australia, we're really looking at Victoria. So we want to see that they can control this outbreak. We want to see the numbers of new cases coming down, and we want to see that it's isolated to Victoria. At the moment, we're seeing a few of those cases popping up in New South Wales, and we want to see that we don't see a great deal of that, and that we see this get back under control again. In the US, the focus is not so much on case numbers as such now. It's kind of got to the point that they've all but given up trying to contain it. The focus is really on whether the hospitals can deal with what's coming in. So far, it seems pretty good. They've cancelled elective surgery in all of Texas, and a lot of the big city hospitals in Florida and California have done that as well. But they do still have capacity in their emergency departments, etc. So far, US hospitals seem to be coping a lot better than expected, and a lot better than they did in New York. So at this stage, everything sort of seems okay there, although obviously there is huge amounts of new cases and still a lot of deaths happening, but their system still seems to be coping fairly well. The other big factor is the Chinese economy ability to continue to rebound, which so far it's doing very well. So we've actually seen on technical analysis, so charts and things like that, the Chinese economy was actually down in a downward trend for about 5 years, and it's actually broken out of that trend now into an upward trend. So it's really interesting to see that the Chinese economy does seem to be rebounding, and we're seeing a bounce in raw material prices on the back of that. So iron ore, gold actually has been quite a bit of demand for. So tangible goods, there's quite a bit of demand for there. Okay, that's about all I've got for my section. I'll pass on over to Gil now if he's ready. How are you travelling, Gil?
Good, thank you, Stephen. Just give me 2 seconds, everybody. I'll get myself going here. I've still got Steve Baxter's screen. I'm trying to see mine.
Yeah, I'll stop the share.
Yeah, I think that might be a plan, Steve.
Yeah.
Tell me when you can see mine, Steve.
I can see your screen, just need to get the PowerPoint up. Yep, I can see that now.
You've got it now? It says Gil's Insights?
Yep.
So the first one, you can see the slide says a little bragging.
Just need to put it into presentation mode, Gil.
Oh, okay, Steve. I have it in presentation mode, but I may have chosen the wrong screen to show you. Here we go. I think I'm showing you screen 2. Have we got?
Yeah, that's better.
A little bragging.
Yeah, perfect. Yep.
So thank you, everybody. I'm just going to take this opportunity just to brag a little bit about Steve and Chris and the other advisors and the staff that work with us. We've had a good year in terms of awards and a bit of recognition from head office. This is very much testimony to a good business and also a good group of clients that we work with. But anyway, if you'll indulge me, I'm going to brag just a little bit about how well your financial planners have been recognised in the last 12 months. So every year, Retire Invest or RI Advice provides a series of awards for practices that have done well by a variety of metrics. We, this year, are the most awarded practice in Australia. We've won 3 different awards, which is more than anybody else, and I'm rather proud of that. Stephen's no small contributor to that. For the last couple of years, we've been a member of the Platinum Club, which essentially means we're one of the larger practices in the country and we haven't screwed up in terms of any quality of advice issues and things like that. But anyway, that's for a second year running, which is lovely. Last year, we went to Hong Kong as part of this program and did a study tour at Hong Kong University. This year, we didn't go anywhere because COVID-19 got in the way. The practice has also been awarded the Compliance and Governance Award. So for those of you that have worked in, let's call it paperwork-oriented industries, you know what it means. It can be extremely difficult to do your job and to run your business in a way that ticks all the right boxes. Every year we're audited, and this year this practice got the highest score in the country, and actually out of something like 1,500 advisors. We got the highest score nationally in terms of the quality of our files and the evidence in our files that show we've done the right thing by the client. Both Stephen and I got a 1, which basically means we had no mistakes or errors in any files that they looked at all. So I'm very pleased with Stephen's efforts and quite happy with my file result as well. The quality piece here is important because it is a comparison of our practice against some other practices that are very, very good advice businesses. So I'm rather pleased that one has come our way. And humbly, I also won the Proprietor of the Year award. That in and of itself is yet another award, but what pleases me most of all is it's not just a head office award, it's actually voted on by all the advice businesses around the country, and my participation in a few forums and councils that I belong to has sort of been recognised, which is good. So I'm rather proud of this business that we run, and I hope that that provides you with a degree of confidence that the advisors that you're working with are very well regarded in the industry. And that's about as much as I'm going to say, other than I'm pleased to be associated with such a group of professional people as I am. Now, I'm just going to quickly run through a few charts here and then get into some political things that I think are coming our way. The question of China is the dominant issue in my mind for the success of the Australian economy going forward. So we all know what China's doing in the media, and we all know the threats that are coming our way. Yet curiously enough, from around about the time the threat started, which is about the time Australia started to push China on being a bit transparent about what happened in Wuhan, the iron ore price has just gone up by 50%. So this is essentially very good for Australian exports. We're also seeing strong figures in nickel. The coal sector has got a bit of a flat spot right now, but that's mainly because every stockpile that could be filled in the world with coal was filled in the 3 months leading from January through till about March or April. So there's a little bit of supply and demand equation going on in coal. But when you look at iron ore, it's essentially the statement about Chinese manufacturing of steel, and it's a very strong statement that supports Australia. You may recall a few months ago, there was this view that oil was in trouble and went to negative values. The oil price has rebounded very strongly from $20 a barrel up to about $40 a barrel. For those of you that have been with us from the beginning here, the American economy needs the oil price to be operating at about $35 to $40 a barrel to make sure that the oil companies that do a lot of shale oil extraction are economically viable. So when Steve talked earlier about the US government support for corporate bonds in America, this is essentially one of the key things that they were doing, was making sure that their energy sector was viable. And we're seeing it in the oil price as well. And that's in and of itself, I'm probably not what you'd call a greenie, but I'm not a lunatic either. We need to be smart about the use of fossil fuels. However, the collection of well, the world itself wants enough oil to keep the oil price where it needs to be for the US economy to be strong. And that's good for Australia and good for Europe and good for the rest of the world. So that's a good one. This graph's a little bit interesting and colourful. It's 100 years of data from the USA. The red line is the unemployment statistics, which traditionally have wobbled around 5 or 6%. The blue line is the GDP growth. And there's some interesting observations in there, and the green line is inflation. Now, one of the things that's true is it's very hard to grow GDP much above inflation. But more importantly, the thing I want to observe is this period from the 60s through to the 90s, which arguably was a golden period in terms of increasing wealth in the Western world, had an unemployment rate of around about 6 to 7%. Now we're in a period of much stronger employment, and in many ways we can actually see a little bit of an uptick in the unemployment rate, which we are seeing in the Western world and in the US, without necessarily suggesting that it's going to be catastrophic for our societies. The governments around the world are printing money so that they can support the unemployed and support the businesses that are, struggling a little bit. But there is nothing inherently wrong with this right-hand end of the curve, the 2019, 2020 figures, where the economic growth is modest and the unemployment rate is quite low. There's quite a lot of room for the average unemployment rate to almost double without it being catastrophic for the long-term prospects for our economies. So historically, just to go back for the quick lesson to the Great Depression back here on the left-hand side of the chart, that's where the US took the view that they will put trade barriers up against every possible competitor for the US economy. And that's what caused the Great Depression. It wasn't the stock market crash or anything like that. It was US protectionism. Now, what's happening with America and Donald Trump at the moment is protectionist policies are aimed purely at China. They're not aimed at the rest of the world. They're not aimed at Europe. They are simply saying, if you're not going to play fair with us, then we're going to make it harder for you guys to make money out of America. And in and of itself, that's not a bad thing. So targeted protectionism is not at all the same as what was going on 100 years ago in the Great Depression, when it was, I think they put protection rules around something like 300 different industries. And it caused the Great Depression when the rest of the world did the same thing back to America. So it basically stalled trade. So the single most important thing to achieve going forward for the next year or so in the world is trade. If money's flowing, to use the old Allen Bond, you've got to move a buck to make a buck. As long as money is flowing, then we're going to have this lean period. We all know that, but it's not going to be catastrophic like it was a long time ago. And you've got to make sure we keep an eye on what the media tells us, because they want nothing more than fear. So just the last couple of slides, I'm just going to talk about how I see the next 6 months playing out, because there's no doubt we're in a war of words with China at the moment. It's all about the South China Sea and some of China's trade practices. I've talked about that a little bit. I want to talk initially about politics. The first comment about politics is that all politics is domestic. The actions of Donald Trump are done to make Donald Trump get re-elected. The actions of ScoMo are about ScoMo getting re-elected. The actions of Xi Jinping in China is all about getting re-elected. So what they say is inevitably for domestic consumption. The things that they don't talk about are the things that affect the geopolitics, the international political scenario, which is why when I showed you that document a couple of weeks ago, which was an economic declaration against China, that didn't make the media because there's no point talking about it too much. It was a statement for China's consumption, not a statement for domestic politics. So always look at this question. It's always about getting back in power. It's always about maintaining their authority. So sitting leaders want an enemy to focus on, and they want the population of their countries and the media to focus on it. So we're going to see Trump, Xi Jinping in China, ScoMo, watch Daniel Andrews over the next couple of months in Victoria come out insanely aggressively, because he needs an enemy to focus on. Otherwise, I think his management of the Victoria situation with coronavirus and also the borrowed money from China is going to become a real problem for the Labor Party in Victoria and potentially nationally. So I expect some really interesting and quite silly rhetoric out of all of them over the next 12 months. So that's the political side of it, which is about rhetoric. Let's just talk quickly about whether we're going to go to war. Now, there are two types of war. There's a physical war and there's an economic war. So in terms of the physical war, it makes no sense at all. On the one hand, the US is arming its allies. It really is arming all its allies in the South China area, in the Southern Oceania region, to stand up against China's stated policy of dominating the South China Sea. Now, the interesting thing, if you actually look behind some of the media reports, the USA is sharing its current technology. Some of it's some brilliant technology they've got. The Americans are really good at blowing things up, right? And that needs to be remembered because the American military technology is better than the Chinese military technology. And if China chooses to pick a fight, a physical fight, America is going to be able to blow them out of the water. Now, that doesn't mean it's going to be a good thing because nobody wins a physical war. Now, ScoMo's committed Australia to spending $260 billion over the next 10 years. That's going to be extremely good for the American military, industrial military sector. So we're back a little bit to George Bush and the invasion in Afghanistan. That was actually not great for the American economy. It was very good for the American stock market. So what the USA has done is gone to Brunei, Indonesia, Malaysia, the Philippines, Vietnam, all of whom are historically unhappy with China or likely to disagree with China's stated policy of dominating the waters around their countries, and said, right, we will engage with you, we will give you the best technology, we will enter into a military pact with you, but you have to buy our technology. So classic America, they're turning a war to their own economic benefit. But the interesting piece here, China in the South China Sea has more local opposition than it has support. And I'll show you some graphs in just a second. The conversation is going to be quite interesting as they amp up whether there is a military conflict likely. But at the end of the day, nobody wins that kind of conflict. And China's not stupid. So when we look at the trade war, we're going to get this kind of thing. And for those of you that know me well enough, you know I'm a fan of the Godfather movies. So you've got to say this with an accent, is whenever I refused an accommodation, right? So we're going to see China talk, but then they are going to negotiate. Now, if you accept that China's going to negotiate, it's always better to negotiate from a position of strength. So it's always better to go hard for a while so that when they do negotiate, they come back to where they want to be in the first place. So I actually think we're going to see a lot more rhetoric. We're going to see a lot of noise. We're going to see Channel 9 and Channel 7 and Channel 10 and ABC go absolutely ballistic on scaring people. But just remember, nobody wins a conflict. They don't win an economic conflict. They don't win a physical conflict. So I very much believe that it's going to get much worse before it gets better, but I believe it will get better. My gut instinct here is it's going to take 6 months to play out. And that's going to be interesting because it means, to support Steve's comment, that we're going to see a lot more volatility in the market. Is America at war? No, it's not. Yes, it is. No, it's not. Yes, it is. We're going to get the same situation here in Australia. So just be prepared to listen to it. Look for the long-term trends because nobody wins a war, ever. So interesting commentary which you're going to see coming out is the Belt and Road Initiative. Now, this is China lending money to the rest of the world to garner political influence. Australia was, up until a year or so ago, independent of the Belt and Road Initiative. But as you see, there's a small circle around Victoria now where they've dragged us in. I honestly think that we're going to see the federal government put a lot of pressure on Labor to extract itself from this. As I mentioned a couple of weeks ago, China has stopped investing in Australia anyway. If you go back 2 years ago, they were investing $5 billion a year into Australian assets and companies. Last year, they invested $1.2 billion. This year, nothing. They have already turned and walked away. They're not going to force themselves on Australia, but they are not willing to work with Australia if Australia isn't going to kowtow to Beijing in terms of political alliance. So the interesting things that you will note here about who has not lent money, borrowed money: India, Japan, South Korea, Australia, and all of North America and some of South America. Interestingly enough, China's two biggest suppliers of iron ore, being Brazil and Australia, are not part of the Belt and Road Initiative. And I suspect you're going to find a lot of political activity from America to prevent this sort of thing happening going forward. We are going to see some tensions around the Middle East and in Africa. Africa is a 25-year story. It's not today's story, but you can see that China is very, very keen on engaging with Eastern Europe and Africa and Saudi Arabia. Now, I personally wouldn't want to engage with Russia. I wouldn't suggest they're the most reliable ally, but this is going to be an interesting map over the next year or two. Now, if we look domestically into Southeast Asia, we see a totally different map. Red being China, pink is China's genuine vassal states, which is Mongolia and North Korea. Green are the states that are siding largely with America. Now, we've mentioned the Five Eyes, which is the military, sorry, it's the intelligence alliance between Australia, New Zealand, Canada, USA, and the UK. But there is another alliance which you'll start to hear a little bit out in the media, which is called the Quad, which is India over here on the left, Japan, Australia, and the USA. So it's 4 points of a box that sort of arguably traps China into a certain extent. The Australian government entered into this four-way alliance 20 years ago, but then Kevin Rudd extracted Australia from that alliance in an attempt to appease China back in 2007, 2008. And so Australia and India haven't got on very well since then economically for quite a while, until just the last 6 months, when all of a sudden India has invited Australia back into the Quad. Now, you're probably aware of the battle that happened in northeastern India, where China and India went to war, but they went to war with sticks and stones. It was quite weird. There was I think there was a couple of dozen people killed, but it was the first genuine skirmish between the two countries in a long, long time. So again, if you recall the conversation around China's efforts to control the trade route down here through the Pacific, past Taiwan, down through the Straits of Malacca and Singapore and up into India, they are totally surrounded by, I guess you'd call it US allies, who are being armed by the US so that China almost certainly can't pick a physical fight. Now, expect a lot of noise out of Taiwan. China's going to foment all sorts of noise in Taiwan, but America's going to be very clever about that as well. So what we're seeing here is, despite China's attempt in the previous graph to control what's going on in Asia, the military might of America with the best weapons in the world, and as the Americans love to say, we're getting really good at blowing things up from a distance without risking any lives, right? This is not going to end in a conflict. It can't, because China can't win it, right? They just can't win it, so they won't. But I do expect that they're going to amp up the rhetoric so that they can step back and negotiate to a point where they're happy with. So expect the noise to increase over the next 6 months. But I personally can't see a scenario where China, who amongst many things is not stupid, right? They may be assertive and they may be self-serving, but they're not stupid by any means. I can't see a scenario where China does anything to damage their national interest. So I'm going to call it on that. Unless there's any questions from anybody, Steve, I'll just jump in and have a quick check of the slides. Is anybody wanting to know anything? I can't see any questions. No, there's no chat questions there. So again, as I've said before to you, it's about what you know, and it's what you do with what you know that matters more. So thinking about these scenarios is part of what we do, trying always to anticipate where the market's going to be and how it's going to affect your portfolios. I think everybody now knows that most portfolios have come through this really well, and we're very happy with the way that we've managed your money, because I've come across plenty of clients that aren't clients of our firm that are down 10 and 15%. Most of our clients are down not very much at the moment, 0, 1, 2, 3% negative. So we're in a scenario for your patience and your wisdom to stay the course is working out well for you. Once again, the entire team's there to be supportive. We're going to be welcoming some more people over the next 6 months or so, and I think you're going to find some interesting things happening within the Retireinvest family. But right now, the business is doing well. We're very grateful for your support. I'm very grateful to be working with a team like this that has resulted in us winning a few awards. And so it's tremendous. So please, everybody, take care. God bless. We're going to talk to you again in a month with the next webinar. I trust you're all safe and well and look after your families. So take care, everybody. Talk soon. Bye now.